Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are up around 80 basis points and we also made a new all-time high today. On the 1 hour chart we approach overbought RSI, the MACD is positive, and on the 4 hour chart we are also approaching near overbought RSI. We start to see a convergence on the MACD. And on the daily chart, we start to see us also approach overbought RSI, and the daily MACD is strong. We do not see a close divergence at all. It is the width between the MACD are very wide, so that is a good sign that this uptrend is still strong and intact. And another note, that we made an all-time high, so that is real positive for the bulls. So if we were to reverse and head down lower, the possible support level that I see is the 18-day moving average. As the days progress, the 18-day moving average shall climb a little bit higher and reach around past resistance. Since we are above the resistance, it acts as support now, so eventually we do see a possible support level around $300.50, and we saw past resistance that dated back to mid-July and even mid-September. So if the S&P 500 were to fall down lower, I do see us stopping around this level at support, and eventually the 18-day moving average shall approach that level eventually at that time and point. So, and as for resistance, we're currently at all-time highs. I can't really mark any future resistance, so only support. And if we were to fall down lower, that price movement is roughly around 1.6% to the downside. So let's head to the forecast model. So this forecast model is now available in the link below for free, so check it out. So I'll go day by day where the S&P 500 will head to in the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally the model that is the best match to the current trend. We have the current trend right here, and below is the trend that I believe is the best match. And this trend dates back to May 3rd to July 28th, 2017. So let me point out why these two charts are similar. So what we have in the current trend, we started off in the bottom Bollinger Band, and then we proceeded to make a nice reversal, and let's mark it as a up channel. So we were up for several weeks, and then we proceeded to break down to touch the bottom Bollinger Band again. And then after that, we see another up channel breaking on higher and even touching the upper Bollinger Band. And notice that we did not really stay too long in the middle Bollinger Band. So in the trend in question, we start to see similar patterns. We started off at the bottom Bollinger Band, and then after that, we see it in the up channel for several days or several weeks, and then eventually we do see it break down to touch the middle Bollinger Band. After touching the middle Bollinger Band twice, we see it break out again and proceeded to touch the upper Bollinger Band. So what we have is 1, 2, 3, 4 points. So we also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was May 3rd to July 28th, 2017. And this forecast model is now available for free, so check it out in the link below. And back then, the S&P 500 was up around 13 basis points, so not much to the upside and not much to the downside. We do see a good possibility the S&P 500 will head to in sideways price action, so not much action in the next coming days. So that is it. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.